You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
Credit spreads have caught your eye.
Well, we've been watching those because there's debate about whether the Fed can actually lower interest rates. And then interest rates have come down a lot, but what you have in here is the difference between investment grade, high grade sector of the bond market, and the low grade, the junk stuff, and that is the credit spread, and it can tell us a lot of the story before bad things can actually happen. And what we've been looking for here is the action in lower grade stuff, junk bonds and European bond speculation was amazing, and so that was part of narrowing of spread. And then you also have a seasonal component to that, whereby spreads can narrow into around June and then reverse. But if you've been in party mode for a number of years in credit markets, financial markets, and stock markets, it's something to watch. So we plotted this in, definitely 1998, which was the year that it was discovered that the biggest hedge fund at the time, LTCM, Long-Term Capital Management, had a problem. They were positioned wrong. They were playing that European interest rates would narrow, spreads would narrow on on the central banks in Europe would narrow spreads as if they could, and it was called the convergence. And so they played it. But then the old seasonal turn, spreads narrowed into around June then, and they started to reverse to widening. And then we moved ahead then and looked at 2007 and used it in 2007 when they started to reverse in that June. And, of course, that was the biggest party in the credit markets in history. And that is also, as the spreads turned to widening in early June of that year, we noted that there was just the start of the greatest train wreck in the history of credit markets. And indeed, that's what did happen. So then again in 2008, you had the hit. The stock market made its high in November of 2007, and then following the widening of spreads, rolled over and the market died, then recovered, and then in the first part of 2008, and then again what came in with the real killer was spreads started to reverse to widening in that June. So we've got three examples that we've used it to our own advantage, and so we've been watching it pretty closely. And so you'd want in early July to have the widening chart break out to new highs, and we did have that. Now then later on, after some churning around, late July, early August, like about now, you would then have another breakout that extended the chart trend. And we're very close to this. We're just, I think, another week or so of this action, and then the extension of the trend will be accomplished. And that'll it sure worked in as I said, 1998, 2007, and 2008, and it should work this time. And it's something that the Fed has no control over. It's purely market forces that push the spreads one way or the other. And so it's worth watching, and it's worth sharing with our listeners and our readers. So we'll keep you posted on this one. In the meantime, the stock market the hottest big one was, of course, Shanghai. And that followed the classic pattern to a blowout on that you saw in 1929. You saw it in gold in 1980. You saw it in the Nikkei speculation at the end of 1989. You saw it in NASDAQ 2000. And so anyways, on the Shanghai, we needed to have the third upside exhaustion readings on our model, and we got those in early June. I think the high in the market was June the 12th, and then it rolled over. Now here's where previous crashes, straight ups and straight downs have been a guide, because you get certain targets. So once the upside had been reached in the Shanghai market in June, the first break would be down to the 200-day moving average. That's where it went, stopped there, and then it rallied up to our target was 4,100 to something, and then having made it by July 24th, which was last Friday, and I did it, and then down again. So the Shanghai market is following the pattern that was established with 1929, or as I say, Nikkei in 1989. So it's worth following in this manner because it shows that markets are quite methodical in doing a blow-off and then following with the contraction. And it's funny, none of this gets into the textbooks. It's amazing how much the establishment avoids looking at market history. Anyways.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. My guest is market historian Bob Hoye. Bob, Barrick Gold has sold off their Pascua Lama property in Peru for $1 billion. After sinking anywhere between $8 and $11 billion into it to develop it. Is this really what's going on in the gold market right now?
Oh, yeah. It's really horrendous. But you consider that it was an almost 11-year bull market, and the final years of it became quite impetuous, and the big mining companies were aggressive in obtaining large deposit or potentially large deposits, and they were in places that were politically dangerous. They were in places where it was remote and access was difficult, or it was places where maybe the geology itself was difficult. So I guess this is what explains that. They did top of the market type stuff, uncritical, and it's very difficult for major companies to stand against the tide of opinion, and they all did it, or most of them did. So who knows what opportunity this presents for those who bought it, but I'm sure that over time, if it's a sound gold deposit, it can be worked out, and also perhaps maybe a serious contraction and slowdown in other types of industry and the economy in various places that are politically challenging, the local politics could improve. I think that can happen. Now, longer term, the prospect for gold is very good because in previous post-bubble contractions, the real price of gold goes up, as we've mentioned many, many times. And it goes up enough such that the industry becomes profitable because, for example, in a post-bubble contraction, you have the real price of base metals going down due to overbuilt capacity in the boom, which we have, and you also then have base metal mines being shut down. You have then equipment and material and labor with a price depressant on it, and then you have gold, which should be holding its own, and so eventually profitability will come back into the gold business. So I think any acquisitions in here of a corporate nature would be very good. Now, on the near term with gold, the concerns were that if gold in U.S. dollar terms fell below that 1140 level, it was a test there a number of times, that it would be catastrophic, the end of the world and everything else. Our view was that it would be the next buying opportunity because perhaps it would clear out a number of the players who have been playing the old paradigm that the Fed is evil, the dollar is going to depreciate forever, and gold's going to go up forever. And that did not work out. And here you have us. Our problem has been to integrate history, whereby the senior currency in the post-bubble contraction becomes chronically firm, and you also have the increase in investment demand for gold. So you get to not thinking too much about the price of gold in U.S. dollar terms or Canadian terms. You get to thinking about it in real terms. And so this is the best bet for gold, is to have the pressures on most other commodities and equipment and mine labor and all that sort of stuff, and then it'll start to work. When the market starts to discount that, I don't know. But this recent opportunity in gold is for traders. Also, the final knockdown last week was down and did record a capitulation, downside capitulation, so we can get a trade out of here for a number of weeks. But it's not the investment side that's talking to us here, it's the trading side. So what we look here now is that with the credit spreads widening, the big stock markets are becoming more and more vulnerable. We're in the season whereby we still think that maybe there'll be the last rally of the party and senior stock index, like the S&P, up into late August, maybe into early September. And then you have to face, all of us will be facing this year's problem when things sell off in the fall. And I think this time it'll be vulnerable. You've had, like last year, you had weakness in the general stock markets into October with advanced declines were declining. The 80 line was heading down, and then it came into last October when we got our springboard buy on the S&P, and then that took us, first target was March, the second target was May, June, and then now the target is out here to September. So, but this time the decay and the advanced decline line is very impressive. So we've had two things that have kept us positive on the stock market. One that are sort of like nails in the coffin. One is the spike in margin debt up to April, and then decline since suggests that that was the spike high, in which case the high for the S&P would be some 2 months later, in that order. You also had the best for the advanced decline lines in April, May as well. It's also that the highs would be a few months later, according to tradition. So we call these our friends of, and looked for a positive environment perhaps through until late August, early September. So there was two things that were providing the count. One was the peak in margin, the other was the peak in ADs, and the other third item was the seasonality. So it's going to be interesting through the last remaining weeks of the summer, and all we know is that let's look at next week and see what the credit spreads do. I think we get a trade out of gold in here. I wouldn't be inclined to trade the silver. As a matter of fact, we're looking at if the gold-silver ratio breaks through 77, and then you would that would be saying troubles are coming back again. So I think the summer is going to be extremely interesting.
Bob, thank you very much for chatting with us.
Jim, always good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com, their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.